What's up, everybody? It's Monday, July 26th. I just sent out the new edition of MMT Trader. If you want to get a copy of that, go to my website, pitbulleconomics.com, and sign up for a 30-day free trial. All right. New highs again in stocks. Last week I said that the Fed's monetary operations, specifically those reverse repos, have created kind of like a Goldilocks scenario for stocks right now. Now, ordinarily, if the Fed was not doing that, and we've been in this situation for at least since March, where we have seen a record amount of reserves being dumped into the banking system, onto bank balance sheets. I've been talking about this for so long. That would have been very destabilizing. I mean, we saw episodes like this in the past, in 2018, late 2018. There was also in 2019. We saw an episode like this that triggered, 5, 6, even 10% corrections in stocks, sometimes even larger corrections than that. But it hasn't happened this time, even though we have seen a record level of reserves. And just I was saying, like in the past few weeks, we have seen reserves up nearly $500 billion. I mean, that is, that would have caused a crash like 2007, 2008, the financial crash, if we were not seeing these operations by the Fed to mitigate that negative impact. And the result of that has been like a Goldilocks scenario. I mean, we even saw last week with weekly unemployment claims, they came in a lot higher than the forecast, at 419,000. And, there was a brief little dip in the stock market, but it came right back. Monetary conditions right now, and fiscal conditions, I'll get to that in a second, but monetary conditions, because of what the Fed is doing, has, again, created this ideal scenario for stocks. And I don't see that turning around unless we get just a bunch of weaker than expected economic reports. Now, I thought that was going to happen. Let me just say that in the month of June, and if you go back and if you watch my videos in the month of June, all during that month, I had been citing the slowdown in the fiscal flows. I mean, we went in June, starting June 1st, average daily withdrawals, treasury withdrawals, in other words, spending, average daily spending was something like 48 billion. It went all the way down to 22 billion by June 30th. But right now, so far in July, what are we today, July 26th, it's back up to like 33 billion average daily flows. So that's a 10-day average, by the way. So the flows have stabilized, okay? You have this monetary environment that the Fed is creating, which is, like I explained last week, that they're just, sweeping that cash off of the bank's books and holding it, in the Fed's account, paying interest on it, 15 basis points. And it's just created this ideal situation for the stock market right now. And the stock market's not going to go down until we see a string of bad economic data. And frankly, I'm not sure we're going to see that with, average daily flows at the level where they are right now. I mean, you need to see flows come down. 33 billion a day average. That's, that's good. I mean, we also have the deficit now, again, above same time last year. It's about 100 billion over where we were last year, but that's understandable because at this time last year, July 15th, tax filings were due, so you had a narrowing of that year-over-year comparison, and actually we flipped back positive. But the deficit is still big. It's like 2.4 trillion or something like that. I mean, that is a significant amount of net transfers. So yeah, that's where we are. We got kind of an ideal situation right now. But let me say this. Wednesday is the conclusion of the Fed meeting. We're having a Fed meeting this week, start tomorrow, concluding Wednesday. There's a lot of talk out there that the Fed is going to announce taper. Taper means a cutback in its monthly purchases of assets. The talk is they will reduce the amount of MBS, mortgage-backed securities, that they're buying. Whatever the reduction is, it's going to be small, but I would expect the market to react to that in a negative way because, this is classic zombie reaction, right? They're taking away the punch bowl. Oh my God, they're not buying assets anymore. When asset purchases, look, let me tell you something. Interest on Treasury securities that the government pays is down 15 billion year over year. That means basically, you can state that another way, a net reduction in transfers, income transfers of 15 billion. 15 billion of income taken out of the economy because of low interest rates. So people who go around saying, oh, low interest rates are stimulus, even central bankers say that. I mean, you see the numbers. They have removed, and it's over 15 billion. It's like 15.5 billion in net transfers, income that would have gone into the economy that are not going into the economy because the Fed lowered interest rates to where they are. So, I mean, whatever reaction, if we get a negative reaction from the Fed's announcement of taper on Wednesday, I mean, you got to go against that. If the market sells off, you got to buy that. You're going to get the dollar's going to rally. You got to sell into that. You're going to have gold is going to dip. By the way, on a side note, I don't talk too much about silver, and I wrote this up in my report. You're going to have to go get the report, at least, sign up for a 30-day free trial. But I will tell you this, that something very, very interesting has developed in silver. All right, it's a little hint. I don't trade too much silver, but a very interesting scenario has developed in silver. All right. Aside from that, whatever happens in that Fed meeting, not whatever happens, but if that Fed meeting triggers a negative reaction, which I'm pretty sure it will if they announce taper, because everybody's going to be talking about, they're taking away the stimulus, they're taking away the punch bowl. I mean, I just showed you the numbers when the Fed keeps interest rates low and then when it buys assets. By the way, the Fed owns 5.2 trillion of treasuries. And I explained this once before, how ridiculous this is. The U.S. Treasury, the government, pays interest to the Fed on those treasuries, which the Fed then turns around and gives back to the Treasury. So it's like this ridiculous setup that is completely meaningless, where, it's like taking money out of one pocket and putting it in another and then putting it back in the other pocket. And, the Fed could rip up those 5.2 trillion in treasuries right now. You wouldn't even have to worry about the debt ceiling because you would instantly be below the debt ceiling threshold by 5.2 trillion. But we keep going with this cockamamie ridiculousness, and everybody's so, oh my God, the debt, which is completely, it's just bogus. So we got a Goldilocks scenario. The Fed has devised, I said this last week, I mean, this has been a brilliant workaround to that situation. If you go back to March, I mean, there was so much worry and angst and just fear out there. And again, I spoke against that. I said, all of that stuff was misplaced. I mean, completely misplaced. But there was a lot of fear about what was going to happen with the reserve bill. The Fed came up with this pretty brilliant workaround, and it's been an ideal situation. So it's going to continue too. By the way, it looks now like pretty unlikely that the debt ceiling is going to get raised or suspended by August 2nd, which is when it has to happen, which means Treasury is going to have to go into extraordinary measures to continue paying the bills, and it'll probably run its account down at the Fed to probably under 100 billion. It is currently now at 590 billion. They have to have it at 450 billion. So what, another 140 billion required, drain on that, which means another 140 billion reserve increase without the Fed's adjustment, obviously. But then they might run that thing, Yellen might run that thing down all the way to who knows what, 50 billion or 30 billion. So a lot of reserve addition to come, but again, the Fed has it all under control. So let's see what happens. Don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. See you tomorrow. Bye.